investing theory. On the previous video, we went through traditional portfolio management, modern portfolio theory, security analysis, passive versus active investors, efficient market hypothesis, essential information. But in this video, we're going to go through risk. So let's get that started. So there are the two largest types of risk for investors are market risk and unsystematic risk. The market risk is the risk of losing money due to the stock price fluctuations. The level of market risk varies depending on the type of investments. For example, stock price risk refers to risk losing money due to fluctuation exchange range in currency trading, while currency risk refers to the same thing. Yeah, but unsystematic risk is for a company or industry which can be reduced by diversification, as we spoke in the previous video, which is a risk management strategy, but mixing assets to create a more diversified portfolio to minimize the risk. But a new competitor in the market with ability to take substantial market share from a company invested in such as a regulatory change, a management change, or a product recall are all examples of unsystematic risk. However, systematic risk refers to the possibility of losing money because of the factors affecting the overall market results, like political risk and macroeconomic risk. Market risk, commonly known as volatility, is measured by the beta coefficient, and you should know it from the statistic video because I showed you how to calculate over there. Anyways, the systematic risk of an investment about the overall market is measured by the beta coefficient. So different industries have different beta coefficient slash risk. Therefore, Tesla versus a grocery store. So a grocery store, both of them are business first and foremost, but a grocery store, the consumers of a grocery store tend to buy the same basic household needs daily, making it a low-risk business with a lower anticipated return. Therefore, grocery stores would have much less volatility because of this. However, since companies is measured of securities uncertainty or systematic risk in comparison to a wider market, the beta coefficient is a measure of how share market value of the company shift in response to change in the overall market. And as a result of this, a company like Tesla, which produces luxury products with highly unpredictable demand, would have a different beta coefficient slash risk than a grocery store. Yeah, so people want to go and buy their weekly grocery stuff, every week, every week, every year, etc. But in Tesla, people buy five Tesla cars or 100 Tesla cars, etc. Yeah, and that was the risk. Let's go into the disadvantages for small investors. And as you can probably figure out what it is, but let's go through it anyway because you need to learn. So the disadvantages for small investors face is cost and information, since it's unfeasible for small investors to match hedge funds or mutual funds. Therefore, the stock market, for example, responds to the wealthy investors by charging them lower fees or commissions on trades. Even if the small investors and hedge fund buy the same stock price at the same price, the higher commission small investors pay will remove most of the profit. Small investors are also trading against experts that have enough time, money, and expertise to fund the research, while small investors are often working full-time job or have another job. So I'll show you what I mean by this. So if you have two graphs here, and both of you bought the $200, you bought 500 shares, your commission would probably be $20 or something, yeah? While the hedge funds only had to pay like $1, which means that they can do more trades than you, and they have more money, and they have more information, so it's unfair, yeah? So since the expertise, time and money are invested, fund manager gain connections with CEOs and CFOs from organizations, which later leads to inside trading that gives big investors an advantage, even though the executives won't reveal more than they are allowed by law. Big investors have an advantage in lobbying Congress because of their wealth and contacts. Therefore, unethical experts/traders may take advantage of small investors in several ways. When insider trading occurs, it is large investors who are privy to the information and know when to sell or buy a stock. Moreover, analysts at an investment bank can therefore suggest worthless stocks to help bank brokers, who are paid commissions when you purchase stock. Also, with the power of internet research, competing with experts/traders without the same conditions will be very difficult. Furthermore, another disadvantage for small investors is that they are unable to purchase necessary platform software, such as Lightspeed, for example. Most small investors tend to use free online platform softwares, which is in some cases they are not developed. So and therefore will lack essential equipment. For example, candlesticks, like I showed you on the previous video. Some platforms don't have that, or real-time stock charts, or real-time news updates, etc., which will make it very, very unfair, and which is one reason why you can't match hedge funds or mutual funds or big investors, etc. Anyways, I've gone through a lot of information, and I would like to make a conclusion. In order to recap all of the above information or all the videos I've made, it is empirical to have a diverse approach when deciding where to invest. It is very beneficial to perform the adjusted research and to understand not only from a statistical point of view, however, to look at the surroundings of a specific economy, therefore meaning that when a choice of an investment is done, the more diversified it is, the higher chance of income we'll have. The discrete combination of the market research as well as statistical research is a very important concept for investors to make use of. The investor at the point must be aware of all possible outcomes and solutions to his or her investment and make the aggregated chances accordingly. All aspects must be taken into consideration in order to keep high turnover rate with minimal risk. So, if you were to invest, so you could either start by buying low. So let's say you started in, let's say you bought 2012, yeah? And let's make this one bigger, like this. And you bought over here when the share price was $10 for a stock. Now, 11 years later, it went like this, yeah? Something like this. And now, your price is, and you sold it here, let's say, and you sold it for $400. This company would be one share, right? So this is one share of your portfolio. And then you have another share. You bought it also here, but this one you bought for $20. Yeah? And you've been looking like this. Yeah? Something like that. This one is now $200 or something. Yeah? This means that you have a portfolio. So the weight of this portfolio right here is 50%. And the weight of this portfolio is 50%. So you can calculate the expected return, you can calculate the risk, you can the beta coefficient, risk, you can calculate the alpha, you can calculate a lot of stuff on one particular asset or stock in your portfolio. You can also do exactly the same thing with this one. So you can do it individually, or you can do it by a portfolio analysis. And in order to calculate your portfolio, so let's say you had 30 shares you have bought in 2012, that looks something like this. You have 30 of these different shares. This is a company A, this is company B, this is company C and D, etc. Then you can calculate the risk, and that's what I'm going to do in the next videos. And do that, it's not that hard, you know. It's the weight of your asset 1 to the power of 2 times the standard deviation of the share 1, 2 plus the weight of your second asset 2 plus times the standard deviation of the second asset 2, etc. You know, if you do this 30 times or whatever you want, etc. And then it's times the covariance, yeah. But more on that, how you calculate on next videos. But I hope you understand the theory behind investing now in stocks and shares, bonds, etc., and the disadvantages, the risk, and everything. And at this point, if you really understand everything I've gone through, you should be I'm confident that, or if I were you, I would be confident in myself to start investing small. Yeah, let me put it that. And as always, I wish you good health. I'll see you in the next video. Take care.